A bank crisis of epic proportions is on the horizon, according to experts smarter than me. So I'm here to break it all down.
So even the experts are freaking out?
Even the experts are freaking out.
Oh, that doesn't sound good.
No, it doesn't.
Taboo News Tuesday!
I have to tell you something. We're not supposed to talk about it, but there's a good chance that the banks don't have your money. While you are all concerned about the pandemic, the Federal Reserve dropped all bank reserve requirements to zero, meaning banks are no longer required to carry any money that's deposited in their reserves. Prior to 2020, under the fractional reserve lending system, banks were typically required to hold 3 to 10% of all deposits in their reserves, depending on how much money they made, to prevent a run on the banks. Not anymore. And this is crazy because if we all try to pull our money out, it might not be there. It is all smoke and mirrors. And by the way, this is already happening and nobody seems to be talking about it.
Yeah, so I guess that's what happened at my bank, First Republic, which went under like a couple months ago, and I never found out why that happened.
Yeah, so with First Republic Bank, they loaned out 111% of all the money that they had. So when people actually came to get their money out, it didn't exist. This is exactly what happened. The 2023 banking crisis is already worse in terms of assets lost than the bank crisis of 2008 that nearly tanked the global economy. So far this year, 3 regional banks have failed. Silicon Valley Bank, Signature Bank, and as we just mentioned, First Republic Bank. These are 3 of the nation's top 30 banks that failed. These banks served the wealthy tech industry and wealthy private clients. Hundreds of other banks are also expected to fail, yet again, no one seems to be talking about this.
So what did cause these banks to crumble?
Well, as the Federal Reserve hiked interest rates to curb pandemic-related inflation, it made low-interest loans and bonds less desirable. Since Silicon Valley Bank and First Republic invested a lot of their reserves in low-interest securities, they suffered a massive loss. Customers panicked and pulled out their deposits to avoid losing uninsured cash, meaning any amount that's above the $250,000 threshold set by the FDIC. To avoid a domino effect, the US government stepped in, ensuring that all deposits at 2 of these banks would be honored. But guess what? The issues that triggered the failures haven't gone away.
Well, it's a good thing that I'm poor. I would hate to have more than $250,000 right now.
Well, here's the problem. You may be broke and not have $250,000, but let's say that your employer has $250,000 plus in one of these banks, and those banks go down, then everyone's going to lose their jobs at that company.
Oh, dang. No, I didn't realize that.
Yeah, it's a big problem.
Wow, that is a big problem. Wow, this could affect all of us.
Yeah.
Holy cow.
That's what I'm trying to tell you.
I didn't know. We should be freaking out.
Yes.
So this whole thing means that more banks can start failing.
Yes, a new study out of the University of Southern California estimates that at least 190 additional banks are now at risk of collapsing in the next year. And that's if only half of all uninsured deposits are withdrawn from banks with $300 billion in assets. Federal Reserve Chairman Jerome Powell claims the U.S. banking system is sound and resilient. But the full impact of the Fed's aggressive post-pandemic rate hikes hasn't hit the economy yet. We've got at least another quarter of a year before a possible recession.
Okay, so is there anything else that's leading to this possible recession?
Yes. The 2008 meltdown was driven by a crisis in residential real estate, and the looming crisis will be driven by commercial real estate. In the age of working from home, corporate office landlords can't find enough companies to rent properties. This means they can't pay their mortgages to the banks that loaned them the money to buy the commercial real estate in the first place. Sure, the banks can sell the buildings, but the properties are now worth far less, possibly even half as much as they once were. In response, banks have significantly slowed the rate of commercial real estate loans to 6% as of June, and that's compared to 13% just a few months ago in March. I can't state how important this issue is. Commercial real estate loans make up more than 25% of the average bank's assets. At smaller banks, commercial real estate loans make up an even larger portion of their portfolios, often as high as 1/3. All this is the perfect storm for a major liquidity crisis. Uninsured depositors, beware. If you or your business have more than $250,000 deposited in an FDIC or NCUA insured bank, and that bank becomes insolvent, you'll only be able to pull out the insured amount, not a dollar more, because the funds won't exist.
Okay, now I'm starting to get a grip on this, I think. let's say hypothetically I was someone that had more than $250,000 in the bank. Should I make a bank run or should I not make a bank run, or what should I do? What can any of us do in this situation?
Well, you could kind of do what my grandpa did during in response to the Great Depression. He basically parked a lot of different amounts of money at different financial institutions to make sure that he would have insurance. But today things move pretty quickly. So back in, the Great Depression era, people would go down to the bank and like get their money in person. Today, if people lose confidence in the banks and they're just electronically making moves, things can happen really, really quickly. And that's kind of what we saw with these 3 banks that went down in March.
Like my bank, First Republic Bank, rest in peace.
First Republic Bank.
I guess
yes,
I have Chase
R.I.P.
now, I don't even know.
Also, regulators are now paying attention. While they haven't reinstated bank reserve requirements, they just proposed changes to capital requirements that would apply to all banks with $100 billion in assets. The changes would require big banks to maintain a certain level of capital to hedge against possible losses from risky activities, but it seems like the amount is something around 4%, I believe. Now, nothing is solidified. This is just proposed for now. While banking customers are vulnerable to getting screwed, the so-called too big to fail banks like JP Morgan Chase keep on winning. JP Morgan Chase acquired First Republic for $10 billion. More than half of all US banks are expected to be swallowed in mergers like this. After 2008, big banks were on notice, but many of them also got bailed out. And today they appear safer than the smaller banks for depositors, but perception is everything. And in March, we got a glimpse of what happens when people lose confidence in banks. So how bad will the coming crisis get? Will the US government bail the banks out again like it did in 2008? Can it even afford to after spending so much money on programs during the pandemic? Stay tuned, we might find out.
Yeah, where is money? Where is money?
What is money? Where is money? Why doesn't anyone understand money?
Why is money?
Okay, today we talked about money, but be sure to check out my next taboo topic, psychedelics, and why the US government might be allowing them to come to pharmacies near you.
Like my local CVS?
Like your local CVS.
Oh, wow.
Be sure to subscribe to my channel. Thanks for watching. I'm Brigida.
Taboo News Tuesday!